Okie doke. Okay, so we're recording and away we go. I'll leave it to you now, Jose.
Excellent. Welcome. Welcome. This week is a lovely topic. I think, out of all the topics we've done so far, I was personally so excited when I saw this topic for this week. It's not something that we generally come across when we're talking with clients, doing our fact finds. I haven't, in my 10 years in financial planning, I haven't seen a question in the fact find which says, is this important to you, Mr. Client? Is ethical investing something you've heard of, Mrs. Client? So it's a really interesting phase we're going through. It's a really interesting movement that's happening across the globe when it comes to responsible investing. I know the topic for the week said ethical investing, but I'd like to call it responsible investing because that's a far more broader concept, which covers ethics, it covers the environment, and it covers all the social issues that go along with investing. So the first thing I want to talk about, and I'm not sure if you guys have actually heard of the Nike issue way back in the 90s. So a couple of cases before we get into the content. Claire, do you remember the issue with Nike back in the 90s?
I think vaguely there is something there where top of my head, no, but I know as soon as you start talking, I'm going to...
Yeah, look, way back in 1996, this is when I was probably just finishing university. Way back in 96, there was a publication which showed some photographs of a 12-year-old boy in Pakistan stitching swoosh emblazoned soccer balls. And the next year after that, they published that because they want to make the public aware of child labor. Not very often do you see factories in China or India or Pakistan or Indonesia or Malaysia or Thailand. You don't see photographs or video of what's happening behind the scenes. So this Life magazine published this photograph. And the following year, one of Ernst & Young revealed that 77% of workers at their factory had respiratory problems and were being exposed to carcinogens, which were like 177 times above the legal limit. And then soon after that was published or leaked, it was kind of the WikiLeaks of the 90s. Soon after that happened, CBS and ESPN started broadcasting footage from inside the sweatshops where Nike products were made. And not all of them were in Pakistan, they were in other countries as well, predominantly in Asia. And that was post the late 80s outsourcing boom when it came to manufacturing. So Nike had moved a lot of their manufacturing offshore into Asia. Have a magazine putting a photograph, the company has to come out and make a statement, and they took a very defensive approach for about 4 to 5 years. And they like top management didn't really think that's going to affect their bottom line. It wasn't going to affect their public image and so forth. But in 1999, Nike's total revenue fell to $8.8 billion. So it was earning in the $9 and $10 billion a year in terms of revenue. In 99, which is 3 years after that magazine published this data, Nike's revenue fell considerably. And to make a long story short, Nike then started to change their stance on taking responsibility and owning up for child labor being present in their sweatshops, owning up for things like unhygienic and unacceptable work environments, unhealthy work environments for most of their factories, which were offshore. And there was a former Microsoft executive who came in and started initiating some change within Nike and turned the company around. Now, so much so that I think it was in 2018 or early this year, Morgan Stanley ranked Nike as the most sustainable apparel and footwear company in North America for environmental and social performance, including its record for labor. Okay, so this was all due to one lady, Jones. She came in, she was a director of Nike, came in and changed the way they did things, changed the perception of Nike as a brand, changed the way all these issues were tackled at board level, and making sure there were better work environments for the people within Nike across the globe, even outsourced factories and third-party manufacturers, etc. Okay, so now, Claire, does it ring a bell?
Yes, absolutely, yes.
There you go. So it was headlines, but we sort of, now when we think of Nike, we go into, like when I go to DFO to buy sports shoes for my kids, I don't remember this. You know, all I think about is, you know, Michael Jordan or, you know, and who the best athletes in the world and how quick they run and how well they play their sport. And generally speaking, they're wearing these good brands. So we tend to forget what happened and the turnaround story. But I guess the lead into something like this, or a lecture which talks about responsible investing, really has to include some of these case studies. Okay, the second one I want to talk about real quick is Bangladesh factory collapse. This was more recent. So we went from the 90s, we come into 2000 and I think it was 2013, somewhere there, where that factory collapsed in Bangladesh. Garrick, do you remember that one?
No, the date I don't remember. I think there was a number of events like that around that time. But do you remember that? Oh, you've probably got that date, did it?
Yeah, so this was 2013. I haven't been to Bangladesh personally, but I'm told that it was called Rana Plaza, and it was named after or owned by Sohail Rana, who was a member of the local unit of the Judo League, which is a youth wing of Bangladesh Awami League, which was the political party in power at the time. So these guys owned a building which housed a number of separate garment factories, including brands like Walmart, Gucci, Versace, Prada, and the list goes on and on. These are the ones that sort of I know of. There are lots of other brands that were manufactured there, but obviously you can tell, you know, from those brands, you're actually looking at high-end clothing, high-end designer brands. People like who go into these shops would spend thousands of dollars buying those brands. Little would they know that those brands were being made in a factory outlet in Bangladesh where 5,000 people worked in a very small, confined environment. Now, this one's not about child labor, but it's more about the work conditions. Now, in 2013, there was some media coverage after some locals made some noise about the building being unsafe. And there was some footage shown on television which showed some cracks in the building. And, you know, immediately after that, like things like this do happen in Asian countries, and immediately people evacuate and panic, you know. So that happened. The building was evacuated. 5,000 workers got out of there in that Rana Plaza building. Later in the day, that politician, Sohail Rana, comes onto the media and he says that the building is safe and the workers should return tomorrow. Okay, this is a long story short. Soon after that happened, the building actually crumbled. So it was April 23rd and 24th is when the building crumbled and collapsed. There was actually, the reason for the collapse was that there was a power outage the next day. And what happened is they brought in some generators, diesel generators, and put it on the top floor. And with all the vibration, it caused those cracks to sort of move into an unstable construction environment, and then everything just collapsed. Now, long story short, in May, I think there were thousands of people dead. United Nations got involved, lots of volunteers from across the globe. But again, what happened as a result of all this is big organizations, big charities and so forth that came and did volunteer work found that this event could have easily been avoided if the companies that were operating or outsourcing their back-end manufacturing really identified that the building was, say, five stories tall, and the top 3 stories were illegal. So the foundations of the building were built illegally. The structure was illegal. It was not built to house 5,000 people, and all those machines and all those sewing machines that generate vibrations. All that was illegal. Okay, but because, and I guess when you look at political influence in some countries, things get overlooked and things get passed based on, you know, who's in power and what influence they can sort of have over others in terms of you know, passing buildings and getting building approvals through the system. So I guess these 2 cases, Nike and the Rana Plaza, just start or is a good segue to get into ethical investing and responsible investing. Because at the end of the day, a lot of these brands, like you look at Nike, Adidas, listed companies, a lot of them have you know, big institutions that invest money. Now, when I talk about managed funds, I thought I'll just talk about the investment market in Australian managed funds. Is about 1.26 trillion in value. Sorry, that's non-responsible investments, and 980 billion of that is actually responsible investments. Now, to give you a total, this 2.24 trillion, to put things in perspective, this is not essentially managed funds. It is the underlying equities that are responsibly managed. Okay, so it is not ethical managed funds or socially responsible managed funds in terms of assets under management. This is the underlying share numbers in terms of market capitalization. So what is responsible investing? And one of the big things we found while putting this, these slides together is that there's some really interesting drivers, and the United Nations has got PRI, which is, when you look at investing or managed funds or equity markets, that seems to be the gold standard of what constitutes responsible investment. So they say responsible investment is an approach to investing that aims to incorporate environmental, social, and governance factors into investment decisions to better manage risk and generate sustainable long-term returns. So what does that mean? You'll hear the term ESG mentioned over and over and over. Claire, do you use that in your investment process at work? Environmental, social, and government?
I'm an accountant, not a financial planner, so I don't do investments. But having said that, every investment that I've made recently for family has all been ethical investments.
That's awesome. Great to hear. So when you say ethical investments, you're looking at things like no tobacco.
Yeah, no tobacco, gambling, environmentally friendly. One of the articles that you had on your reading list, which I got to have a read of very quickly, Better Shares Global Sustainability Leaders ETF. That's one of the investments.
Yes.
looked at, and the UBS ones as well, so Australia and the world.
Fantastic. Fantastic. So how did you select those investments?
I was looking for ETFs, and I didn't actually realise that there was ethical ones available. But of course, as soon as I saw that was in the actual listing, I then went and did a little bit more investigation and went, that sounds pretty cool. So as soon as I became aware of it, basically, it came onto my list of things to invest in.
Yes, and when you look at Vanguard and BlackRock and all the big ETF providers across the globe, this is becoming a bigger and larger focus for them because of the appetite of consumers asking for those products.
Yes.
So traditionally, Claire, you'd have managed funds, and now a lot of clients are actually getting into that ETF space. And now, once ETFs have become more and more popular,
Yes.
you're getting more focus in terms of ESG related ETFs. So, and that's something we talked about with Garrick. If you remember, Garrick, last week we had a chat about just the amount of green ETFs available globally. The size of that market is huge, whereas in Australia we're very restricted in terms of what's available, and we still have a long way to go in terms of in the ETF space and socially, environmentally, and responsible investment space. So if you've researched North America, you've got huge amount of variety in terms of ETFs, green ETFs, so to speak. And it's just something that I think is gaining traction in Australia now, with probably a year or two behind North America when it comes to these sort of products. So what's the backbone of something like this? I think research is definitely the backbone. So how do financial advisors, how do super funds, how do big investment houses, investment managers or charities or companies or corporations decide on what is a responsible corporate entity? What are the basic factors of responsible corporate entities? So can you think of a few things that that one would want to look at when we look at screening out a corporate entity? So we talked about tobacco. We talked about gambling. What other factors would you like to screen out when you look at responsible investing? Child labor we talked about? Yeah.
Climate change.
Very good. I think you took a hint from that leaf there in the background. Okay? Excellent. Climate change, big one, big ticket item. So look, a lot of, I've got all the tobacco companies out there on the top of the next slide, but a lot of funds that focused on ESG have exclusions with the money. When you look at advisors and clients, it's really important that we understand what's important to a client. For example, you can't just, when we go through this presentation, you look at the universe of managed funds that are considered ethical. But you look at the shades of green and dark green and light green that come into the equation purely based on things like uranium mining, for example. Some funds will say, we definitely won't do weapons, we won't do uranium mining. So that sort of screens out a lot of these big mining companies that have a small part of their portfolio or small part of their revenue stream that comes from uranium, for example. If you look at gambling, okay, so when you look at traditional companies like Crown, for example, we'll screen out Crown. But then what about companies, little companies like Aristocrat Leisure or Jumbo Interactive? How do we know whether we should screen them or not. What does the Aristocrat Leisure do? Do you guys have an idea? They make gambling machines. What's that, Garrick? Yeah, they do make gambling machines. Jumbo, on the other hand, makes software that helps companies like Tabcorp run their lotteries. Or they do online, they have online lotteries or online gambling software. So that's a little small cap. So it's just moved, that company has just moved into the ASX 300. So it's now getting a lot more recognition and spotlight just because of its market capitalization. So when you look at fund managers don't have a very easy job. Say if you're running an ESG fund or an ethical fund, an ethical share fund, where do you draw the line? Where do you say, well, in a small market, which is the Australian market has got 24 million people, and by market cap or market size is relatively small, the top 20 companies probably will include your Tabcorps, your BHP, your Rio Tinto, and so forth. So where do you draw the line? So a lot of the ESG funds or the ethical share funds in Australia do have some limitations just because of the market size and the market caps. So they do have something called a materiality threshold. And that's, you see that in auditing as well, isn't it, Claire? Is it material or is it immaterial? Less than 5%, over 5%, or sometimes it's 10%. So they have thresholds and they'll work out, okay, only 5% of BHP's revenue or less than 5% of BHP's revenue comes from uranium. And the rest is iron ore. Some of it is coal. Okay, so that fits within our guidelines. So they'll put a threshold in place. So it's really hard. It's really hard for them in a constrained environment to put an ethical share fund in place in a small market like Australia. But globally, that's definitely, if you're running a global share fund, definitely you'll have a much wider universe of stocks to sort of pick and choose and make sure that if you don't want coal in your portfolio, you can say no coal, done. If you don't want uranium, there are plenty of other mining companies in the world that don't do, that just focus on one asset rather than a diversified player like Rio Tinto or BHP. So some funds do not screen out companies, but focus on companies that are well positioned to benefit from and contribute to sustainable goods and services, responsible finance, and required infrastructure. So the process, I think, is most important in screening out your tobacco, alcohol, pornography, and the like. I think that's important. And when we look at process, you will see all the rating agencies and how they come into play for advisors and investors to make an informed decision on what assets, what managed funds, what ETFs to invest in. All right, this is pretty involved. But sure in your little research, when you look for those ETFs, you probably came across some share funds and these names that are featured on the left-hand side. I can confidently say I use one of these funds in a few clients' portfolios. But there you go. Just have a quick look. We'll go through the first one. So on the left, you've got the fund names. Sorry, Claire, were you wanting to say something?
No. I'm just making it bigger so I can see it on the screen.
Excellent. So on the left, you've got the fund names. The second column is the APIR code, which is the code that they use on platforms to identify the fund. Market cap bias talks about whether it focuses on small shares or small caps or mid caps for large caps. So large caps would obviously be the larger companies with substantial market capitalization. So let's have a look at the first fund there, Australian Share Fund, AUG 0002 AU. So exclusions in the fund. Now we talked about that in the previous slide about how certain things are screened out and what the fund's mandate actually is. So when you look at exclusions, you'll see that this list, for example, when you look at tobacco, if I'm excluding tobacco, I can't have any of those Philip Morris, British American Tobacco, Imperial Brands, Japan Tobacco, or Chinese Tobacco. None of them in there. Now that's a pretty broad exclusion to have, hey, miners, fossil fuel investment, coal investment, polluters. How do you screen out polluters? How do you know that Nike's factory in China isn't polluting the air in China? Well, no coal means I don't invest in BHP, Rio Tinto, Peabody Energy. I don't know. There's a whole lot of exclusions there. Fortescue Metals, do they do coal? No, they do iron ore, isn't it?
Mm.
Yeah. Okay. Animals. I'm not sure what they mean there by animals, but I'm assuming
Animal testing.
Animal testing, products that use
Oh, you reckon veganism?
Yeah. So we're probably looking at, this is the reason why small brands like BWX are getting really popular. They make these all natural and vegan hand cream products and facial products and so forth. But it's listed, it's a small cap listed on the stock exchange, and it's getting so much attraction because people are paying attention to these things. People are paying attention. They want to have all natural, no animal testing. And there's this big trend, isn't it, Claire, for people going vegan? I see that at even social events. What's going on? It's very interesting. Now, manufacture and sale of alcohol. Now, it is legal. Garrick, we had a chat about marijuana last week and how it is in some parts of the US, it's legal. But there's this social stigma attached to marijuana. Now,
that's something that's similar with tobacco. There are legal things which are not considered to be acceptable. And so that kind of throws up some interesting possibilities.
Yeah. And alcohol is the same thing. It's acceptable in today's society. It is acceptable at a social event to have a nice glass of red or a Chardonnay or a beer or a nice Johnny Walker Black. But in certain countries, like, for example, in Bangladesh, for example, where big population is Muslim, they don't consume alcohol. That's not acceptable.
It's almost an inversion in some places where to go off and smoke some hashish or something. It's acceptable.
You might have to speak up a little, Garrick.
Okay. I was just thinking you almost got an inversion. That if around the northwestern frontier of Pakistan, doing a little hash is not a problem. In fact, it's rather sociable in the same way having a beer is here. But to pull out your Johnny Walkers, you get skinned. And so you've got this sort of locational ethical dimension to it as well. Can you hear me okay with it?
Yeah, it's cutting in and out. It's cutting in and out, but I think that's probably because I haven't muted myself while you're talking. I'm not sure. Claire, were you able to hear Garrick okay?
No, I couldn't hear him at all.
Yeah, It might be your broadband connection in Port Macquarie, Garrick.
Could be. I'll try chatting.
Fair enough. Fair enough. All right, but some really good points raised there. I think geographical differences and cultural differences make different ethical biases when it comes to investing. The same goes with gambling. You know, in Australia, Crown is a big one. I've named some other ones like Aristocrat Leisure and Jumbo and Tabcorp. Commodities falls under mining as well. Worker exploitation, we covered that off in the Nike case. And human rights breaches is also a big one. I think going through the entire list, you'll see there's a lot of commonalities right through with the first one. You look at the AMP fund as well. AMP's got weapons in there. They've got pornography in there. They've got nuclear power, including uranium, and we touched on uranium in the previous slide. Thermal coal, exploration, development of oil sands, and weapons. So, really interesting one, because there are companies that make weapons and explosives. And some companies make explosives and supply it to departments of defense. And they also supply explosives to mining companies that need it for their mines. So how do you screen out an explosives company? If you said in your fund, you're okay with weapons, but you're not okay with, you're okay with mining, but you're not okay with weapons or explosives. So very interesting. So these are the things that a fund manager, I think, would need to consider. Okay, what percentage of Orica's revenue comes from explosives to defense departments versus what percentage of revenue comes from explosives to mining companies? Well, maybe only 2% goes to defense. Well, then that might be an acceptable investment for them. Tick. Pendle. Pendle is actually the new name for BT. So BT used to be called, Pendle used to be called BT till like last year, till the Royal Commission, I think. So tobacco, alcohol, weapons, gaming, environment, and human rights prosecution. So it's pretty narrow. And I think there's a clear correlation, at least what I see in my portfolios, there is a clear correlation, at least in the short term, between the returns on investment from ethical share funds and the returns of investment where there are unethical share funds. So what do I mean by that? Is if we're in a small market like Australia, for example, if we are stripping out maybe 6 or 7 stocks out of the top 20 stocks on the Australian Stock Exchange, what is my compromise in terms of return on investment? It's a very interesting one because this doesn't essentially happen around the world. When you have a global share fund, you've got a much bigger pie. So if you're stripping out from the S&P 500, if you're stripping out 50 stocks, you still have 450 stocks in there with a reasonable market capitalization. And then you've still got, the MSCI World Index where you can pick stocks from around the world. But in Australia, it's a very small pot or a pie. If you strip 5 out of 20 large caps because they're gambling casinos or, a bank that is unethical, then you're left with compromising on a lot of potential returns. So it's a very interesting concept when you look at a smaller market. What happens when you strip out BHP and Rio Tinto from the top 20 stocks? you've got return on equity in excess of 15-20% in those cases. Does that affect your overall portfolio returns because you've chosen to go that route in the short term? You'd like to believe that in the long term, if you are stripping out all these companies that are harmful for the environment, they don't have good ethical business practices, they're exploiting their workers, you'd like to believe in the long term, those companies will eventually not outperform the companies that are doing business the ethical way. Paying attention to human rights, having gender equity on their boards, having factories in Asia, yes, but also making sure that they're not exploiting children, making sure that those factories and their working environments are safe, and so forth. So, Penny, for your thoughts on that. Globally versus Australia.
Long term, there's obviously a compensation issue for those ones operating on an unethical basis. So any of them that are like James Hardie that are doing something that's unethical will compromise their returns later down the track anyway. So while initially they might have good returns, the unethical behavior does have an impact on them.
Yep. Are you referring to the use of asbestos and things, all the compensation that they have paid out?
Yeah, well, and then take into account the banks as well, the compensation that they've got to pay out in the after recent unethical behaviour as well. So there's, that compromises the profits at the end of the day. So when you're looking at a company that hasn't got, worker exploitation, if it does and it's making good profits now and investing in it, it doesn't mean long term it's a good investment because of compensation that would be required in that circumstance.
Excellent point. Excellent point. And we've got to make the assumption that those who compromise on quality and standards and ethical behavior do eventually get caught.
Yes.
And yes, so that is very, very important in this transparent environment that the stock market lives in. So excellent point, Claire. The one path is actually owned by ANZ, ANZ Wealth. So they've got one which is called the Affinity Fund. And there you go. It's quite broad, and you've also got logging of old growth forests. So that's very interesting. Gold mining is an exclusion. Then you've got some common themes there, similar to the AMP fund. They've also got some chemical fracking in there and Arctic drilling in there as well. So quite deep in terms of mining and high impact fuels and so forth. Animal welfare, again, that seems to be a common theme. Pornography and predatory lending. Subject to a 10% cumulative revenue threshold. So that's a very interesting disclosure. So I'm assuming that means that they will allow partial fossil fuels as long as the company only gets up to 10% of their revenues through fossil fuels. I'm assuming that's the case in this one part sustainable investment fund. The next one's pretty popular. I'm sure many of us would have heard of this one in investment circles. Again, pretty straightforward. Nothing different from the rest of the clan, apart from the genetic engineering side of things. So, Garrick and myself had a chat about certain religious institutions and them having them not being in favor of things like abortion, genetic engineering, animal cruelty when it comes to cloning and all that sort of stuff. So this is also something that it's relatively narrow but relatively popular. in terms of ethical investing or socially responsible investing. I thought we'll just go through, because that's a new one that's come in. What are your thoughts on that, Garrick? We did talk about this last week when it came to ethical investing. I think you mentioned a church or something that has some reservations about abortions and genetic engineering and the like.
Yeah, I think it's just another illustration of the way that you can have very different ethical. Can you hear me okay? I'll chat.
Yeah, I've been thinking about getting one of those headphones with a little microphone for these things.
Yeah.
And that would that might work a little better.
Okay.
All right, do we have a chat box? Claire, what are your thoughts while Garrick's typing? What are your thoughts on the whole genetic engineering piece?
Genetic engineering. Or there's obviously some benefits from genetic engineering, but the plain God problem is also controversial. So, when it comes to hereditary diseases that we could exclude by genetic engineering, I'm going, yeah, there is some limited amounts of benefits, but genetic engineering, screening for blue eyes versus brown eyes, or, playing God when you come to think of some genetic disabilities being a disability, which are in actual fact something that's really quite cool, like Down syndrome. To exclude Down syndrome from society is excluding a person full of love. It's one of the biggest blessings some people have in their lives. So I don't know. I'm sort of on the fence with that one.
No, very good point there. Very good point. And where do we draw the line with these sort of things? When it comes to and you'll see my last slide with, if movies are an indication of the future, like think about the movies you watched 20 years ago, 30 years ago, 20 years ago, say 20 years ago, they were talking about video phones, and now I went, nah, that's never going to happen. Yeah. And now look at you and me. We're on a Zoom meeting where we're not even having a phone in our hands, but we're able to communicate video and voice. And in Garrick's case, he's also chatting. So, it's fantastic. I mean, so movies are a good indication of what, if they are a good indication of what's out there in the future. I think there are already movies being made or have been made about cloning dogs and so forth, isn't it? I forget which one. Was it an Arnold Schwarzenegger movie where there was a clone dog? And when that movie came out, I don't think the first they'd actually trialed that, but I'm quite sure globally someone has trialed that already. Was it a sheep that they announced has been cloned?
The sheep cloning, so Dolly the sheep was cloned.
Dolly the sheep, like that? Yeah.
Yep.
So all these things have happened in movies. Now the movies of today are talking about space travel. They're talking about driverless cars, which, I mean, that was probably 10, 15 years ago anyways, driverless cars. But that's happening. Tesla just announced that they are ready to go, New York to Los Angeles, depot to depot, driverless truck, 100% success rate on the freeway, but they're just waiting for legislation. So how many hundreds of millions of jobs are going to go as a result of artificial intelligence, as a result of driverless technology? Are we looking at the social impacts? You know, so there's a lot in here when it comes to, you know, where do you draw the line? Like you said, you know, where do you draw the line with genetic engineering? Where do you draw the line with the advances in technology? There are lots of ethical considerations that one needs to look at when we're considering the future and all the technologies that's available today, and how do we use that effectively in the future. Let's move to CFS and AMP. I do have CFS on the next page. AMP, finally AMP is in a slide for the right reasons. Alcohol, armaments, tobacco, gambling, nuclear power. Well, pretty straightforward. We've just got one additional one, which was cluster munitions, landmines, and chemical weapons. So equities, look, when you look at equities, this is domestic. We've got very limited options, but on global stage, we've got lots more. Now, when you look at research, this is a nice, I've got one of the on the reading list, you've got CAER and their reports. Really good resource when you want to look at independent research for ratings and sustainability funds and ethical share funds, and the macro themes that they follow and how they screen out certain investments. So really good resource there, CAER. It's on your reading list as well. And Mercer, I'm not sure if you can see the last column. I actually can't see the last column because our video is in that section, but Mercer has ESG ratings. So if you've got access to Mercer, it's a paid service. Excellent resource to actually see the ESG rating. So they have ESG rating 1, 2, 3, etc. LongSec also has ESG ratings as you do with CAER, which I spoke about earlier. Just on this, we'll just go through bond funds. So obviously, bond funds involve debt. A lot of them corporate bonds and comparison of two, which are available on most advisors' APLs. And again, here very, very common themes in terms of what and how they actually construct their portfolios and the exclusions within there. So I'm very interested in the PIMCO one, the PIMCO ESG Global Bond Fund. You look at it, it says bottom 15% of sovereigns on transparency, corruption indices, controversial weapons, above 10% revenue following conventional weapons, tobacco. So when they look at revenue, that's what revenue does the government of these countries get from companies within their jurisdiction, pornographic material, distribution of coal, or violating UN Global Compact principles, etc. So this is a very interesting one because it's actually talking about bonds and not investing in governments, corporate, when their revenue from these companies is about 10%. So the government's tax revenue is above 10% when the companies that are generating that revenue are domiciled in those countries. Quite a complicated way of looking at things, but very interesting way of excluding certain countries and those sovereign debt in this bond fund. So did you need some clarity on that, Claire? It's quite involved in terms of how they screen out certain countries.
Only
this particular fund.
It's got a no under positive screening. How does that impact what they've there?
Look, not actually sure. I might actually research that with Mercer and see what that one is all about. Because all the others have yes, positive screen, yes.
Yeah.
Yeah, let me write that one down. I might get back to you. This one's come off the Mercer Research Center. So, large miners, fossil fuels allowed, internal research, and no to positive screening. Yeah, I'll research that and come back to you.
So positive screening is investments that target companies or industries with better ESG performance. So they don't target companies with better ESG performance, but they've still, yeah, it's a little bit confusing. Yeah.
Interesting. I think this will be a good question for Mercer to just see on what basis they've actually put no in that column and them to elaborate on that. I'll put the answer. I'll get that straight from the horse's mouth, and I'll post that on the Resources Center when I get to know what that is. So that's the PIMCO ESG Global Bond Fund. Okay. All right. All right. Nice. Today, this morning, when I was finishing this presentation, I saw two butterflies just out in the back garden flying around. So I thought I'd put the sign of spring is here. And a nice butterfly there. It's a 3D butterfly. I can actually move it around. It's a beautiful little addition into PowerPoint. But just coming back into advice, the European Union is working to require advisors to seek out the sustainable preferences and values of clients in their fact finds. And we spoke about this earlier. In my experience as a planner, I actually don't recollect my past employers having a section in the fact find relating to, is this important to you? Is responsible investing an important part of your thing? That question should be there. It should be there in the client's goals and objectives. When you're doing a client's risk profile, is this important? Because that then allows the advisor to tailor make a solution that's focused on ESG. Beautiful read, Responsible Investment Benchmark Report. It's a new report. It's in your reading list. And it's got some amazing concepts in there. So the summary of those recommendations talks about the advisor needing to conduct deeper investigations into their clients' values, moving from a simple risk profiling to a more goals-based approach. And if you don't have that question in your fact find, Claire, is it an extra question that you need to ask the client? It's like this: if you're doing a fact find, and in your fact find that your licensee is provided, you don't have a question which says, do you have a will, Mr. Client? Or Mrs. Client, do you have an enduring power of attorney in place? If that question wasn't there, doesn't mean we don't ask that question to the client. Does it mean that that's irrelevant and not important just because it's not in your licensee's template as a question to be asked? Do we have a duty of care to maybe broaden the scope of discussion when we're talking to our clients? And I think that's very relevant. And I'll give you a small story, if I may. We do have some time on today's schedule, so I'll go through this really quick story, and then we'll come back into sustainable investing and why we need to have those deeper conversations with clients. So back in 2008, I had a client. I was in, and Garrick would be familiar with this place. I was in a place called Castle Hill in New South Wales in Sydney, sitting down in a bank branch. I was a new advisor in New South Wales, and one of the existing clients of the bank had come into the branch, and she wanted to the couple wanted to review the investments, and the previous advisor had left. So, they were, so to speak, they were orphaned. So I sat down with these clients and I went through their investment portfolio. It was a small one. It was under $100,000, non-super. Went through, everything was a bit volatile at the time. Obviously, 2008 was the global financial crisis. And their decision was to stay invested. I did a quick record of advice and closed the file and moved on to my next appointment. Now, long story short, about 2 months later, so this couple, the wife walks in to the branch and she asks to see me, like totally frantic. So the lady on the counter comes, Barbara, she comes back to my desk and says, you need to come out. So-and-so is here. She wants to see you straight away. She's looking stressed. She's in tears. So I come rushing out, take her into an office and I sit down. And long story short, I found out that her husband, who I met with her last time together, had suffered a nervous breakdown. And he was in hospital for 10 days. I believe there's a mental health institute somewhere in Blacktown. So he was there for 10 days, couldn't recognize his wife, couldn't recognize his 3 daughters. Now she said, look, he's been in this institution and I need $10,000 from that investment. It's really urgent. I've got to pay that bill. So can you help me, draw that money out of the investment? So I went into my system and had a look. The investment. Now, Claire, you'd be thinking about this going, oh, I know where you're going with this. The investment was in his name, tax purposes, with a loan attached to it. Okay. So basically, she's told me 2 things. He's not of sound mind because he's in a mental health institution for the last 10 days, couldn't recognize his wife or his 3 daughters. And the second thing is they didn't have a power of attorney. Okay. And I had to be the bad guy and talk about how I couldn't help her draw the 10,000 out of the investment. That's not a pleasant discussion to have. Okay. Now, 2 months earlier, I could have recommended to these clients to actually get a power of attorney. Okay. They had no other money. He was the sole bread earner of the family. He was a tradie of some sort. Like he was like an electrician or a plumber or something. I can't remember. But if she had a power of attorney and she walked into the branch or it was registered with us, I could have filled the form and she could have had the $10,000 straight away. So moral of the story is, if it's not on your fact find, doesn't mean you don't ask the question. Do you have a will? Do you have a power of attorney? If not, go see a solicitor, get that done. That's important. Okay, same thing with this. Clients don't know what they don't know. And I think, when you speak to clients and their backgrounds and their moral compass, a lot of them would indicate that they want to have ethical investments in their portfolio. A lot of them will indicate to you in some way, shape, or form that they would like to know more about it. Okay, so at the bottom of that page, you see over 60% of Australians do expect their advisors to incorporate their values or consider the social or environmental implications of investment. So that's published in that report. It's a riveting read, Claire, and I'm sure you'll have the time to go through it. It's a good read. And I think that's one of the things that, how I shared a template of a research document with you last week. Yes. That's one of the things in our practice we tend to do is ask the client, go a little bit deeper with what's important. Do they need us to incorporate these values into the investment analysis and portfolio management piece? So we touched on this earlier. Top 10 stocks of the Dow Jones Sustainability Index. People perceive that those stocks would basically be in favor of good quality environmental and social governance. But when you look at it, would you actually agree? Like when we talked about BHP, we've talked about a lot of stocks in Australia's top 10. And we've got Tabcorp, we've got Woodside Petroleum, we've got Oil Search, we've got Orica, we've got Newcrest Mining, West Farmers Group, and all of these, or a few of them, would be associated with climate change or environmental degradation in some way, shape, or form. And when you look at their disclosure documents, you will see the disclosures coming through of what breaches they've had when it comes to occupational health and safety, or you're talking about polluting the environment, or you're talking about, like Peabody Energy has closed down a mine. They had a fire there. They had some, water contamination issues in another mine. There are all these little disclosures that come up. But do people actually, when they look at these large corporations, and they're in the top 10 on the sustainability index?
Christy Salsa.
I'm sorry, Chris, you shouldn't be at this hour. Okay, put that on silent. So people perceive that companies have this moral and social obligation towards climate change, and they perceive that they're doing a good thing. But when you look under the hood, it's not always a pretty picture. It's not always a situation where you get to know all the truth. You and me need to do the research. Sometimes we need to engage people like Mercer or Van Eyck, Standard & Poor's, or Morningstar on decision for our clients. Greenwashing is an act of making a product or practice appear more environmentally or socially friendly. Very true, happens all the time. We see what we want to see. They show us what they want to show us. So a fund might claim to screen out fossil fuels. However, the exposure limits are so high that big oil and coal companies remain in their portfolio because they have mandates. And like I said, in Australia, our markets are really small and constrained. Another example of a firm greenwashing is an electrical firm which promotes its internal recycling system while it lobbies to fight clean air regulations. Is it okay to trust, or should we search for more information about companies' sustainable practices? And I think everything's pointing us towards research, because as advisors, I'll give you another quick example. I worked for a company many moons ago, 6.5 years, which was a diversified financial services conglomerate, if I pronounce that correctly, conglomerate. So they had a bank, they had a wealth management arm, and I'm sure they had some other businesses like property development and so forth. But they had won an award for the best Australian equities fund manager of the year from 2005 to 2006 to 2006 to 2007. And when I sat down in my office, I had these glass awards behind my desk, which said Fund Manager of the Year, Money Manager, I think it was, Fund Manager of the Year awards, 3 years in a row. So when a customer walked into your branch and they walked in and sat down at your office, they saw these awards, they went, I want that fund. What fund is that? I want that one that won the award. Now, it's great, but no one in the bank would actually tell the client that in 2008, that 9-member team that was running the fund walked out of the bank and they joined or started their own little investment management firm And all the millions of dollars that were invested in that fund were orphaned with a passive fund manager until they found a replacement team to manage that money. Who was going to tell the clients about this? Do you think that bank would have proactively gone to the Australian Financial Review and put it in the front page of the newspapers? Do you think the bank would have called each of their customers and let them know that their team of professionals that were managing this money have left? No way, Jose. So, is it okay to trust a single advertisement, or should we search for more information? So the only way you as an individual or advisor or the customer having a relationship with an asset manager that has access to research, that's the only way you'd get to know this information. So as an independent advisor, you have access to Mercer or Morningstar or whatever, these research houses, and they tell you, guess what? Suncorp's 9-member team has left. This fund is on a watch or is on a hold. As an independent advisor, don't recommend that until further notice. And then you relay that information on to your client. So the same thing about greenwashing. Greenwashing is very popular. But I think more importantly, this is something that you've got to read the fine print. You've got to read the research, get into the details of the top 10 stocks in a portfolio to understand from an ESG or an SRI or an ethical portfolio perspective, where your money is being invested and how it's being invested. All right. Any questions so far? Claire?
I was just thinking in relation to, circumstances like that being something that actually becomes regulated disclosure. For example, I often receive an email from a company if any personal details accidentally gets exposed to outsource, which means that when you've got a company like that, it should probably be regulation that direct communication with shareholders to say this is something that's there, not just an ASIC announcement or or regulated on that side of it.
True. And I was talking to some of our fund managers at the last conference, and they said, this level of disclosure is there in the US.
Okay.
In the US, they have to disclose to, I think it's the Securities and Investments Commission in the US? I forget the body. SEC, I think. Is it? Yeah. Yeah. So they have to disclose their complete stock list in every managed fund. So if you're a managed fund or an asset manager and you want to operate in this space, you need to disclose to the regulator periodically all your assets, all the shares you hold in that fund, complete transparency. So now, do you disclose that to your unit holders? Where's your intellectual property if you disclose that to your unit holders all the time? There's a bit of a gray area there. But things like this, when a team leaves, I think it's mandated that your research houses get to know that information as soon as it happens. So that's how mobs like Mercer or S&P or Morningstar know about that, and that's how they can reach out to asset managers with information as it happens. Yeah, should it be regulated? Yeah, I think so.
That may help someone who has got an ongoing financial advisor who's got access to that sort of information, but an individual investor may not have that. So direct disclosure to the individual investor would be more appropriate.
Spot on. I agree 100%, and that's I guess the regulators have a lot on their plate, but that's something that they should be addressing along with all the items on their Royal Commission list. How are managed fund providers communicating directly with the unit holders with regards to things like this? Do they owe them an obligation to fire off an email as soon as something like this happens? Do they have a duty of care to do that? Not just let the research houses know. I agree with you 100%. So this slide talks about Australia's top 50 funds not publishing their full proxy voting record online. And this was recommended by the Cooper Review. I think Jeremy Cooper is now head of Challenger. He did the Cooper Review. And 20% of these 50 funds don't publish them at all. So very interesting statistics. So as advisors, how can we know what we're supporting or what we're avoiding and the impact we're having on the portfolio if you don't actually understand the full stock listing of what you're invested in? Now, an ETF is pretty transparent in terms of stock listings. Managed funds generally give you the top 10 holdings in Australia. They like I said earlier, intellectual property. They generally don't tell you more than what they need to, which is the top 10 stocks. But it's good to compare those top 10 stocks. Have a look at top 10 stocks in all of your ESG, SRI, ethical portfolios, and have a look at, what kind of stocks are they investing in. So we have a critical role in helping our consumers, I think, to navigate and understand the question of full stock listing comparisons, and obviously share the research as well. There are plenty of different models used, Claire. Most research houses have models that they use in terms of selecting and screening out. And the next couple of slides typically talk about models that are being used in the industry today. If you want to see further, we can go onto your reading list, and that's picked up from Responsible Investment Benchmark Report. These two models here. All right, now let's get on to some fun stuff. The reason why I put a lot of technology in this slide is because we talked about movies, and 2 weeks ago, Claire talked about a driverless car. So I thought that's really interesting because that's something that is on the cards. It's being debated about. And if movies are any indication of what the future is, you'll see why I put technology out there, because artificial intelligence is sort of taking over the world, so to speak. So Alphabet is the holding company for Google. We all know Microsoft, we all know IBM and Apple. Big data. So what's actually going on in this space? Where are these companies investing? What, if you were a shareholder in Alphabet or Microsoft or IBM or Apple, do you know where the future is for these sort of corporations? Where are your dollars getting invested and what's going on in that space? Claire, would you like to throw some comments around technology and try and relate that back to socially responsible investing?
Oh, that's big ask. Technology responsibility.
I suppose, ethical relativism and cultural circumstances obviously have a big impact on what people would think is ethical. And in one country, it might be that, like driverless cars, it's appropriate to actually protect animal life over human life. So the technology that we've got now is really dependent on AI, artificial intelligence, deciding for humans what is appropriate and not appropriate. And that can be a huge ethical dilemma, I think.
Absolutely. Absolutely. I mean, there was another debate about if you have 5 passengers in a car and it's going at 100 and they're all adults and you've got 5 children walking across the road and the car's got a choice between hitting those 5 children or swerving and going and possibly killing all 5 adults in the car, swerving off the road. What does the car do? What does the AI do in that situation? Do you save the 5 young lives and get rid of the 5 older folks who live their lives? I don't know.
And it really depends on the
Or
country.
just puts its hands up and says, I don't know what's going on here.
Based on the country that it's made, or do you program it based on the country it's being sold? And the difference between those 2 countries is huge. So if I'm buying a car that protects the passengers outside, that's not going to work for me if I'm driving a family car. But if I'm driving a prisoner escort van, like save the people outside the car, not inside the car. So, and then it comes down to, I'm then judging the quality of human life and ranking it. And that's obviously not okay if you're talking to someone else entirely. So maybe technology to have its own settings, so I can choose my own settings and I can choose what I actually want in my driverless car to be the outcome. But then am I responsible if I've then knocked someone off and then get charged because that was my decision to knock them off and not me? Like, it's got huge legal impacts as well. So I don't think these driverless cars are going to be on the market quickly because this is so controversial.
Did you know that some mining companies are already running driverless trucks?
Yep.
There you go.
How did they program? And they went, not my problem, it's how I got it, so they can abdicate their responsibility.
Yeah. Drones are delivering packages through remote control or pre-programmed flight routes and that sort of stuff. But look, you can only imagine how hard the jobs are of the regulators to pass this legislation. And I think your points were all really valid. What about the social implications? We looked at this is artificial intelligence and the moral compass of the AI, or the programming of the codes and the algorithms that are built into a driverless car. What about the social implications? You've got to think about, I spoke about the driverless truck, New York to Los Angeles. Elon Musk is ready. He's waiting on legislation. But when that comes into play, you are talking about 300 million jobs, truck drivers' jobs, in Europe and North America going in a matter of years. I mean, needless to say, you probably have a driverless Uber following the driverless truck. So think about the taxi drivers and the Uber drivers.
You have that conversation continuously, hundreds of years, because, as soon as we introduce new technology, obviously there's a whole area of job growth that disappears, but a whole new area then gets created. So we need programmers, we need computer technicians, we need electricians if it's solar, there's a whole huge range of new jobs coming out that replace those obsolete jobs that we had previously.
Yes.
Used to have phone booths everywhere that someone had to maintain. Now they're all gone. So where did the employees then go? They go into and they get retrained into different jobs themselves. So just because we're losing some doesn't mean there's not a wide variety of new jobs being created.
Spot on. And I think the regulators have a very challenging and number crunching time ahead of them when they look at the social impacts. Because when you take, driverless technology and pilotless technology, and you put them all together with Uber, Lyft, not black and white cabs, what am I thinking of? Ola and all of these operators, it's going to be not hundreds of millions of jobs, I think, across the globe. When the globe transitions, if you've lost 1 billion jobs, can you replace that with 1 billion software programming jobs and all the other jobs that you talked about? That's, I think, the biggest challenge the world is facing with if they go down this path, and there's not enough jobs down the track. And when Barack Obama was in power, he talked about a global base minimum wage. You remember that?
Oh, I don't remember that, but we've had that conversation ourselves, just having a basic living wage for every person.
Yep. Absolutely. So there are lots of social considerations there when you look at what the technology as a whole can bring to the table. And then the next slide is actually done by Magellan. Magellan is, Hamish Douglas runs the fund, and a lot of their investments are in this future of technology and the space where you have technology-driven industries. So I use Siri all the time. I'm like, Siri, can you please tell me when my next appointment with Garrick Small is? And she goes, do you mean Garrick Smale or Garrick Small? And because I have a client, I shouldn't say that, but with a similar name. So Siri is getting very very intelligent. She is understanding my accent, which is great. And she's also plugging stuff in my diary. When I'm driving, I can talk to her, dial different numbers. 3D printing, we've seen jobs move from China back to US. Huge industries have moved back because of the advances in 3D printing. Medical technology, you have brain surgeries, etc., happening with robotic arms. I'm not sure if you guys are up to speed with what's happening in brain surgeries these days. It's a robotic arm that does a lot of the work in some private hospitals. Augmented and virtual reality. So those of us who have kids, my son went to, where was it? He saw this augmented reality cricket game and he wanted it. Fantastic developments in technology. Robots, driverless cars, we talked about, humanoid intelligent robots. There are 3 movies, if you have time to watch: Transcendence, AI or artificial intelligence, and She, or is it She or Her? She. Great movies on humanoid intelligent robots. And like I said, if movies are an indication of where this world is heading, it's very interesting to get your head and ideas conceptually around these films. In 2007, the iPhone was invented. In 2007, facial recognition technology had a 6% error rate at airports when they scanned your face. And in 2011, the human error rate, so if you and me were looking at people at an airport, we'd make an error of 5% of the time in recognizing that person's face. In 2011, this artificial intelligence at airports overtook the human capability. You can only imagine their accuracy today. When you go onto Facebook and it says, "Oh, is that Garrick?" Before you've uploaded a photograph, it tells you who it thinks it is. So that's the level or depth of technology. So I think where we're heading with this conversation is purely around looking at not the traditional ethical considerations when we're constructing portfolios, the traditional ones like your gambling, your alcohol, tobacco, sex industry, defense spending, and all the other things that we talked about, like marijuana and the like. We are looking at the future and all the future ethical considerations when it comes to technology and portfolio construction. Okay, so we don't have time, I don't think, to run through a quick exercise, but I thought if you've had some time to design a portfolio of 50% Australian and 50% international using ESG methodology, but Claire, this probably is not going to be built. This exercise is not built for you if you don't have access to research in your practice, like a Mercer or an ESG research, but maybe something for homework for you to actually go back and have a look at. If you were to design your own portfolio, 50% Australian and 50% international shares, what would you choose and why would you choose that? Yeah. What are the ethical considerations? Would you, after all the things that we've discussed, would you go back and consider avoiding gambling? Would you avoid alcohol? Would you avoid uranium mining? Would you avoid tobacco in your portfolios? What would you do? Good exercise. So what are your thoughts on that at the moment? You usually look for ETFs that screened out the bad stuff. Was that easy to find?
Yeah, it was actually. So because it was a ComSec portfolio that I was setting up for my daughter, and I was specifically looking for ETFs, they did have a wide variety of them. They actually had quite a lot lower management fees than some of the other funds as well. So ComSec does have a bit of information available on there. But it's interesting because you've mentioned a few times about gambling, and I remember when Unitab was first floated way back in the 90s, and I got the application forms to take on or subscribe to Unitab, and I was obviously very young at the time, but I still looked at it and I went, I just can't do it. I cannot invest into a gambling product. So it's the one share that was floated around that sort of time period that I just went, no, I'm not doing. And of course, for a while there, I regretted it because it did go up so much. But now I'm going, well, thank God I didn't.
Yeah. I was going to put something in here in the slide. It said, all the stuff you told you never to do, which was drinking, smoking, and gambling, which are bad for you. Yeah. Those companies actually make irresistible returns. I found that online on something, and I said, no, that's just something we won't put on this session today. Irresistible returns is what I found. But look, at the end of the day, I think a lot of us feel the same when it comes to certain types of investments. A lot of us, it's about having that depth of knowledge and understanding and awareness of what's underneath the bonnet. What is actually happening behind the scenes. And you don't get that information just from reading the fine print in an annual report. You get that information from going deeper, looking at those reference websites that I've pointed you to, looking at your research houses and actually seeing what's under the hood, and then making an informed decision. So, we've covered off a lot, but basically I've done some research on Mercer. Mercer is our research house that we use, and you've got ratings ESG 1, ESG 2. So really good exercise for homework to go back and see what research house are you using in your practice. And it doesn't matter which research house, as long as you're getting access to that information and looking at the ratings and then deciding where your customers' investment funds would lie based on your philosophy around ESG. Okay, so I thought we'll finish off there. We're spot on time for our 1:30 finish. Garrick, was there anything else you wanted to add to today's session? or he's typing. Sorry, Garrick, I don't think we can see. Can you see what he's typing? I don't.
Oh, he said no.
Nothing. Okay. Where do you see that? I can't actually see that.
Up on my screen.
All right. What about you, Claire? Was there anything else? All good. What about you, Claire? Anything else you'd like to add?
Only that when you were talking about technology and the future of technology and losing jobs and things like that, one of the things, obviously, from an accounting point of view, we're getting computer packages like Xero that are coming out now that are taking over bookkeeping roles. And your article, one of your previous reading lists on property and ethics, was talking about trades versus professionalism, and relating those two together, and not being able to see a product or an end result from a professional versus you can get an end result from a trade. I think technology is taking away a lot of the trades sort of side. So, you know, the professionals obviously are still there and do add value to using products as like Xero. And, you know, so due to direction and the ethics and the ethical behaviour of professionalism is really going to be important, because that is going to be where the jobs are actually left. Does that make sense?
Yeah, absolutely. Absolutely. And like we talked about in, I think it was 2 weeks ago, we talked about how technology would enhance all this regulation. It enhances the financial planner's ability to deal with complex regulation and complicated research and documentation, and using technology to make the practice more efficient. So yes, it might take away some jobs, but at the end of the day, it's for us to deal with, as financial advisors, to deal with a whole range of compliance that's coming on board. Like we talked about the automation of file note templates to some extent, all the pie charts and future projections, and mapping up the goals with the strategy in your statement of advice. If you were to sit there and do that manually using a paraplanner in Microsoft Word, it would take you days to get a good document. Whereas you use a good piece of technology, you pay $500 a month and you're able to do that in a matter of hours. So we're not in Singapore where we don't need a statement of advice to give advice. Yes. We don't live in Dubai where you don't need to even have documentation. They just fill the form and put in $1 million in a managed fund. You know, we're living in Australia where we do have a compliance regime that we need to adhere to, and we're just using the technology to improve efficiency. So in every single profession, the wave of technology that's coming is just going to enhance efficiencies, in my view, and that's the key. So it's not like I haven't, in my practice, I haven't taken any jobs away by bringing Xero in. We use Xero in 2 of our businesses. I pay $47.50 a month for each license. So it's fantastic. You know, people can work remotely, scan from their cameras, put all the invoices in. That's great. In our practice in financial planning, you know, have we lost any jobs? No. We're dealing with the extra work through using technology more efficiently. That's all. And I think that's here to stay.
For me, we never did bookkeeping. So we always made it a requirement of the client to actually do the bookkeeping. We only did accounting. That was it. Bookkeeping. Yes. So Xero is a product that's actually creating more work for us. It's not eliminating more work for us. It's creating more work because it's more time consuming than the old school ways of their record keeping. So for us, it's building our business, not decreasing it, because we just do that accounting side.
Yeah, my accountant who does, you know, the BAS and the tax returns and all that, he tends to export the zero file into some other software. I forget what it is, and then he does his work from there. So it's a bit of double handling, I suspect. But look, I'm not a practicing accountant, so I don't actually get into the detail of that side. But he does, yeah. He exports all the data from zero into something else and then gets the financials done. Yeah, if that makes sense.
I suppose it's easier for us because I have a practice in Brisbane that's just zero based and lodged on zero.
Yeah.
I have a practice here in Gladstone that has got zero clients and they're done in zero, but at the end they're exported into my software.
Yeah.
It is better than zero software.
That's exactly what he says. Yeah, that's why he does that. Yeah. Yeah.
But we export it at the end once zero has actually been set fixed and made compliant, which is extremely difficult because zero is not compliant. It's a New Zealand-based program, so it's not Australian-based. It doesn't reflect Australian tax, and you really do have to do a lot of work and then, you know, put it into zero because zero can't actually do it. So that's probably why he's exporting it.
Yes, now I get why he's doing it.
Yeah.
But no, thank you for your inputs. I will get back to you on the PIMCO Global Fund, that particular question that you asked, and I'll post that on resources, or I might just shoot an email to everyone if that works.
The only other thought that I had involving this whole thing was I did a little bit of work with corporate social responsibility and Milton Friedman, and his concept of how you know, the priority of businesses should be to make profits. Not to be corporately socially responsible. So, you know, factoring that into this whole discussion, I don't know if you're going to do that at some future date, but I think that's an interesting thing only because, you know, it has a big impact on ethics within companies.
Yeah, and look, you've got to have two different sides to every argument. We meet fund managers at every single conference that we go through, and most fund managers, their performance bonuses are tied to the underlying performance of the funds, and they tend to be young 20-something or maybe 30-something year olds who have different objectives and mandates, and they're not. Some of them are not running ethical share funds, so that's not part of their mandate. So, you know, I guess you will come across the statements because their KPIs, their goals are not aligned with the underlying goals of the fund or the mandate of the fund. And they will, you know, if their sole objective was there to make money for their shareholders or unit holders, you know, they'd have Philip Morris and Crown Resorts and Aristocrat Leisure and Jumbo all in the one portfolio, you know, so without giving much consideration to environmental ethical considerations at all. So there are two sides to every argument, and I think you know, in our industry, in the financial planning industry, when you meet fund managers, you will always find fund managers who have that mentality because their KPIs are not aligned with that of the client.
Yeah, I think that one's just a good one to debate because there's so many opposing views.
Yeah.
And whether it's the company or the individuals that are corporately responsible. And of course, the shareholders are the ones that are purchasing the shares, and they've decided they want to be ethically responsible. So therefore, you've got a lot of these ETFs coming out that are ethical companies.
Yeah. Yeah. Spot on. Spot on. I'll have those items posted as soon as I hear back. And we'll have this, Garrick's recorded everything, so we'll have this posted on under resources as well. All right, thank you.
Thanks, Jose. Thanks, Garrick. Always a pleasure.